Post-crisis reform is working its way through the banking system. I'm here with Tidjane Thiam of Credit Suisse to give me his insights of what the future holds. Welcome, Tidjane.
Good morning, Caroline.
So, investment banking, is the model dead?
No, I don't think it's dead, because investment banking performs some very key functions for the economy. For any market economy, companies need funding, whether it's debt or equity. They will take each other over. They will merge, etc., and we provide, if you wish, the service that allows all that value creation, that creative destruction to be pedantic, to happen. So there is a legitimate role for investment banking, but what we've done at Credit Suisse is to try to build a strategy around doing things for the real economy. When we are in London trading with one of our peers and trading long interest rate swaps back and forth, that is not really the best way to create value for the economy. So we are focusing on basically equities, which is really, if you wish, the most important thing for companies and something that emerging markets very much need in the process of getting their companies to market. And we are also investing in basically investment banking and capital market, basically advisory, equity capital market, debt capital market, which we see as growth areas, and staying away from things like macro, very long-dated, very complex derivative products, which we have found to carry much more risk than reward. So it's a new definition of investment banking, which I think actually is gaining currency in the industry, if I may say so.
So why is it that American rivals are stealing a bit of a march on European investment banks?
I think some of that is driven by the regulation. I don't like to complain about the regulation, because the reason why there is a backlash is that we did blow up. Financial services sector. The regulators didn't just wake up one morning and say we need to increase regulation. And I've got to say, if you look at the size of banks in Europe, it's completely different from the US. We fund 65% of, if you wish, of companies' needs versus maybe 35% in the US. If you look at the size of the biggest US bank compared to the US GDP, it's a fraction. Whereas you take the two top Swiss banks, we're bigger than the Swiss GDP. So, I mean, banks should not be surprised that in Europe they get a different level of attention. I think that's unavoidable, as long as we have taxpayers and voters.
Are we moving more towards the American model, though?
I think that's desirable. I think in the end we should, capital markets should play a bigger role, which is another reason to stay in investment banking. European companies have suffered chronically from a lack of equity. Too much debt, too little equity. And this is why actually the cycle often generates so much casualty, because so many casualties, there's not enough equity in the system. So really having more sources of equity capital and having more vibrant capital markets is a big part of the difference between Europe and the US in terms of resilience and economic dynamism, I think.
You obviously bring some fresh perspectives on banking, coming as you do from the insurance sector. You have scrapped an ROE target. Could you explain the rationale for that?
Well, it's a bit back to my management philosophy. I often say that management is not a popularity contest. If you can do the right thing and be popular at the same time, great. But if you have a choice, you go for the right thing. And I just think I knew there would be a lot of criticism because of that choice we made. But I think it's more honest. I think it's more humble. And I think in the end it will prevail, because I have said, and I have not been challenged on that every bank that has issued an ROE target in the last 10 years has missed it. So we're not saying we don't give any targets. We've given very detailed, granular profit targets. So we're on the hook on absolute profit. We've said how much capital we would use. We're on the hook for that. We said how much cost we would afford. We're on the hook for that. I mean, that's a lot of targeting. So what I will not do is make a bet on long-term interest rates and have a numerical ROE target, because that's just making yourself a hostage to fortune, and experience shows that it doesn't work.
And throughout your career, emerging markets has obviously been a focus. Could you give us quickly some of your macro thoughts? Yeah, my macro view on emerging markets, maybe it's because I was born in one, is that the infusion of modern technology in those environments can only lead to GDP growth. So I'm optimistic long term. Of course, there is volatility.
commodities and political cycles, etc. But the long-term trends are very healthy, and I see slowdowns in growth in emerging markets as great opportunities because a lot of people with very short-term horizons are retrenching.
And for the medium term, how will that shape Credit Suisse's business going forward?
I think it's driving already Credit Suisse very largely. If you look at the shape of profits we gave, the targets we gave, we'll end up being 2/3 emerging markets, 1/3 Switzerland. And given that emerging market proportion grows faster than the other one, it's just an inexorable progression, I think.
Tidjane Thiam, thank you very much.
Thank you for having me, Caroline. It's been a pleasure.